All right, we are moments away from the start of this market here today on this Friday morning. I'm Paul Sweeney in New York City. Caroline Hyde is in London. This is a special edition of Bloomberg Markets on both Bloomberg TV and radio. Quick check of these futures right before we get this market. Boom, there you go. Negative futures here, and kind of a little bit of a wait and see on this market. Going to be a low volume day, likely here week between Christmas and New Year's here. So a little bit of a softer opening as we're seeing from the futures market, Caroline.
Currently have 9 million reasons ringing the bell over at NASDAQ today. Largest volunteer-based food pantry in Long Island City. So a worthy cause during these holiday-light volumes of down 0.6% as we were just talking about. Yields just creeping ever so higher. We're at about a 7-month high on the 10-year yield, and oil just trading up a little bit. But we want to dig into some of the individual movers. And I wonder why we're going to the publisher of Sports Illustrated next, because it has got a tiny market capitalization of just $67 million. But Alex Semenova has the reason as to why we dig into this company in particular, and it's all about the NYSE.
Yeah, Caroline, so a tiny market cap, but a really big move on the stock this morning in a quiet trading day. This is the media company that owns a variety of media brands, including The Street and Men's Journal. It was notified by NYSE that its plan to regain compliance with its listing standards had been approved. It's up about 17% right now, quite the move, and shares were up as much as 20% in pre-market trading. There was also news yesterday that the fitness website Men's Fitness had relaunched under this company, and the stock was up 12% yesterday as well. So pretty solid run this week.
The magazine business. Go figure. What else are you looking at?
So also taking a look at none other than GameStop. Shares were lower in pre-market trading today, but it was up all but one of the last 8 trading sessions, and also had a pretty solid move yesterday, up more than 5% after a post on X by Keith Gill, who is also better known, of course, as Roaring Kitty. Really interesting to see this name moving nearly 4 years after the meme stock frenzy back in 2021. In fact, at one point yesterday, trading volume on this name hit almost 5 times the 20-day average. It was also the most mentioned company on StockTwits over the last day. And of course, moves like this suggest that investors, are still piling into speculative companies, that policy may not necessarily be restrictive, since we're seeing some such moves on these high flyers.
All right, GameStop, it's got a market cap of $14.7 billion, up 87% year to date.
Incredible.
I don't know. I know a lot of people traffic in this name in the meme stock world. I'm not one of them, but it does get a lot of volume. Alex, thank you so much for joining us. Alex Semenova, she covers all the equity markets for Bloomberg News. Again, S&P 500, if you're just looking at that, 20% plus gains in 2023, 20% plus gains, like 24, 25% gains in 2024. What do you do in 2025? Let's talk to somebody who does this stuff for a living. Caterina Simonetti, she's at Morgan Stanley Private Wealth Management. She's a private wealth advisor over there. Caterina, again, I'd love to hear kind of the conversations you're having with your clients as you close out a pretty successful 2024 and think about next year. How are you talking to your clients these days?
Well, Paul and Caroline, thank you for having me on the show. This is a really important conversation because it's not lost on clients that we've had double-digit returns for 2 years in a row, and it is only reasonable to expect that the returns in 25 are going to be somewhat subdued. So clients are concerned. The questions that we're having about how to capture returns in the portfolios, how to maximize the income in the portfolios, and most importantly, risk management in the upcoming volatility. And to be fair, our expectations for the year are not dim. We think a lot of emphasis is on Fed and inflation and how all the other factors are going to play out. But when it comes to the practical things that we do before the year end, rebalancing the portfolio and achieving maximum portfolio diversification in stocks, bonds, real assets, and private investments is the absolute key.
So, Caterina, again, a lot of folks are saying, boy, can you have a third year of performance in the equity markets? And to the extent you want to be a little bit more cautious, boy, you can look at the fixed income market. How do you think about the fixed income trade? Do I sit there in a 2-year treasury and get, 4.3% from the U.S. government, or do I take some credit risk?
Well, Paul, if we are expecting that Fed is not going to have quite as many rate cuts as originally expected, it's not necessarily the absolutely worst thing in the world for fixed income investors. Number one, we're going to get higher yields of cash for a little bit longer than expected. And two, if we don't think about fixed income as per se a trade, but as a hold and as an asset that delivers that consistent income and risk management, because on the risk-adjusted basis going into 25, we prefer bonds over stocks. We think it's going to generate yield, but quality, very much so within bonds as well as stocks, is going to be the name of the game for 25.
Volatility, because there's so much, well, lack of clarity as it currently stands. Katerina, just take us through the thought process over at Morgan Stanley Private Wealth more broadly as to whether or not the Fed will cut more than 2 times. What sort of realistic inflationary pressure will we get from the talked about tariffs that are yet to be imposed?
Caroline, where do I start? Uncertainty about the Fed, uncertainty about inflation, uncertainty about the tariffs and immigration, as all these headlines are going to start coming out in early 25. All of this is going to play a role. And so our expectations for the early half of the year come with the expectation of the higher volatility. And last couple of weeks gave us a bit of a taste of what's to come. Now, we tell investors not to chase rallies. And this is the other side of this coin, where we have to prepare and stay calm and make sure that we have high quality portfolios, focus on sectors that generate yield, focus on the areas like financials, industrials, materials, and make sure that we take some profits off the table and avoid higher concentrations in the portfolios. We've had some fantastic performance. This is the time to take some gains.
But the problem is you had fantastic performance in 2023. And if you'd had that mindset around an NVIDIA or the Mag 7 then, boy, did you miss that rally of 2024. NVIDIA's up 180%, let's call it, for the year. So how do you talk some of your clients out of that FOMO feeling that a lot are going to be feeling all over again when it comes to quantum and AI?
Caroline, it's only natural to feel this way. And I think that what we have to ask are the valuations and profit expectations that are on the table, as well as the fact that Fed has a lot of pressure on them, when it comes to inflation in terms of cuts. Are we going to get as many cuts as expected? That is a big question for us and for them. So when investors are looking at their holdings, of course, it is natural not to be missing out on the continued growth. So we don't advise selling out of the entire position, but healthy profit taking and diversification into the other areas where the growth of that level didn't occur yet, and where the possibility of future growth are significantly more substantial than they are in technology in some of these areas that achieved remarkable growth in both 24 and 23.
Katerina, how do you talk to your clients about alternative investments? I'm thinking private equity, private credit, hedge funds, because when I speak to RIAs, I'm really surprised at the high percentage they allocate to alternatives. How do you guys at Morgan Stanley think about it?
Well, in the time where investors are so concerned about the risk and volatility and protecting the values of their portfolio, having the asset class that could hedge the risk in the equity side of the equation, it's extremely valuable. Now, it comes with a cost, and that cost is liquidity. So investors that are comfortable with giving up some of the liquidity in their portfolios are perfectly fine using the alternative investments, because it has huge value, with and making sure that we achieve consistent risk-adjusted return. But with that, it's just a piece of the puzzle, where fixed income delivers income, equities deliver growth, cash delivers liquidity, and alternative investments are extremely effective in risk management.
We're going to have some changes to the tax policy, it seems like. We'll see how that plays out. Then that kind of goes to the asset class of municipal bonds. I'm a big fan of municipal bonds. A triple tax-free treatment is I think, a good and wonderful thing. How do you guys position municipals in a typical portfolio?
Well, taxes are a major concern, and inflation is a concern as well. But when investors are looking at their portfolios and analyzing the after-tax income and after-tax performance that they're receiving, tax efficiency is something that is a part of every single conversation that we're having with clients. And this is where municipal bonds come into play. Now, with municipal bonds, you have to make sure that the tax equivalent rate of return that we're getting on muni bonds is actually as good or better that return that we can achieve in corporate fixed income, because there are some amazing buying opportunities on that side. But investors certainly like having that tax-free cash flow in their portfolios, especially in retirement.
Taxation clarity is something that perhaps the crypto world is potentially yearning for, gurning for 2025. How have you thought about crypto and that particular area of potential investment, alternative investment for the 2024 into 2025, Katrina?
Well, Caroline, when you think about the development of crypto world, right, turned from something that we don't mention or talk about into something that was, the most exciting part of the portfolios, then the most volatile part of the portfolios. And now we're seeing more of a legitimization or the use of crypto in the normal portfolios, with availability of ETFs, with people feeling more comfortable investing, in this type of investments. But they can't lose track of the fact that the volatility still remains extremely high. So the positioning in the portfolio has to be extremely careful. And investors that are relying on crypto for liquidity certainly have to have that in mind, because the volatility in equity markets is high, but our expectations for volatility in the crypto world is significantly higher than that.
And meanwhile, though, going back to the equity markets, where there's still going to be some volatility, I'm interested in your overweights, industrials, utilities, and software. And actually, that software shift from hardware to software, from chips into a Palantir or to a software application of generative AI has been a theme we've been hearing. But talk a little bit more about the industrials and utilities. What drives that for 2025?
Caroline, we're looking for defensive plays. We're looking for companies that are not just delivering attractive earnings outlook, which is something that we see across the board. And of course, we'll be looking across the board, for 25, but also that bring to the table attractive valuations that didn't have that explosive growth that some of the sectors we're seeing. So that's where the industrials, that's where the materials, that's where consumer staples come in. We're looking for qualities and also for companies that are in position to make money, to be profitable in 25.
All right, Katerina, thank you so much for joining us. Always appreciate getting some of your time and your thoughts on these markets. Katerina Simonetti, Morgan Stanley Private Wealth Management. She's a private wealth advisor over there doing some good work for her clients. And Caroline, I think, as I think about 2025, again, I got a Fed, I guess, is going to cut a couple of times in 2025. That's about it, is kind of what the market's telling me. So I really need to have earnings to come through here. So that's why I read like Gina Martin Adams of Bloomberg Intelligence and her look on earnings. But we're looking low to kind of mid-teens earnings growth is a forecast for next year.
And how does that potentially feed into the valuations that you already see?
Yep.
Like the valuations that we keep seeing, which have been so jaw-dropping, the valuations that we've akin to more than $3 trillion, not only just for an NVIDIA, but a raft of other big tech companies. How are they growing into that? And actually, many would say, look, with a 40 times future earnings, look, NVIDIA isn't that expensive overall. And we're going to be talking much more about tech in the next sort of conversation we're having. We're listening into the Dan Ives of this world, who, has an outperform rating on nearly every single stock. It would stand at the moment. I think he's got 0 buys at the moment. 0 sells and 42 buys. But he does like Apple still, and they've been raising that price target there.
Yeah, he has. And, Dan, we've known Dan for a long time, and he's been super, super bullish. And for the exception of 2022, really since the great financial crisis, he's been generally pretty right to be bullish on tech. Technology very well, obviously, Caroline, with your reporting there. But he is a perma bull. But again, he's riding big themes. And I think the latest big theme is just, AI across the board. So
Apple Intelligence.
Yep, Apple, and we'll see Apple Intelligence. That's the thing. I think it's in my phone. I don't know, but we'll see. Anyway, we're gonna have some conversation with Dan Ives from earlier, and talking about the tech-based AI trade in general and how best to play it for investors in 2025. This is Bloomberg. Good morning. All right, Good Friday morning. I'm Paul Sweeney in New York City. Caroline Hyde joins me in London. This is a special edition of Bloomberg Markets, streaming live on Bloomberg Radio and television. Looking at the markets here in this first 15 minutes of trading, we got some red on the screen. The S&P is off about 0.7%. The NASDAQ off 250 points. That's 1.3%. So a bigger sell-off here in the tech-heavy NASDAQ. Looking at the bond market, yields just slightly higher. 10-year Treasury 4.59%. Let's call it there. And WTI crude oil in the commodity space up about 1.25%, around $70.50 per barrel. Bitcoin off just a little bit here, around $95,000 per token. So there you go for the opening there, Caroline.
And interestingly, that oil drift higher may be helping some of the oil stocks. Biggest points contributors to the S&P today, ExxonMobil is up there, Chevron is up there. The biggest drags, interestingly, basically the entire Magnificent Seven, Nvidia, Microsoft, Amazon, Tesla, Apple. And it's Apple that we want to go to next at the moment, Paul, because look, even though we got a points drag on the day, boy, Apple's had a nice year.
Yeah.
And actually we've got an outperform and a price target being raised over by none other than, well, one of the biggest bulls on the street. It is none other than Dan Ives of Wedbush, raising that target to 325. And it's all about sort of this perpetual upgrade cycle that many keep thinking will happen. Will Apple Intelligence get us there? Have a listen to what Dan Ives told Anne-Marie Hordern a little ago.
So why now? Why lifting the price target now? This awkward week between Christmas and New Year's, and you said, I have a call to make.
Yeah, because the bears, they're in hibernation mode because they can't find AI in the spreadsheets. And look, we're doing the work. What we see across the Asia supply chain, I mean, we're seeing strength not just into December, what I believe is going to be ultimately a record year for Apple, 240 million iPhone units. And that's why, look, this is going to be an AI-driven supercycle that's multi-year. And that's why, look, the haters, they hate it at $2 trillion. Despise it at $3 trillion. At $4 trillion, going to be yelling from top of the mountains.
You write in your note that you estimate roughly 300 million iPhones globally have not upgraded in over 4 years. So do you think this upgrade cycle is going to be led out of necessity because people are just desperate for a new phone? Or is it that AI capability that Apple's starting to introduce?
I think about 60-70% of it is that you've gotten to the point now where that's a pent-up upgrade cycle. It's really unprecedented for Apple. But also remember that install base, that's increased 200 million even over the last few years. So the install base continues to be the golden goose of Cupertino. But the AI-driven piece, it's just starting. That's why it's a get out the popcorn moment, because in our opinion, the consumer AI revolution goes through Cupertino. And I think, look, that's why the bears will talk about valuation like they have for years in Apple. It's about some of the parts, about what AI adds to the story. We think it's $30 to $40 per share.
How hard would it be, though, for the next upgrade cycle, especially if so much is driven now by software updates? The hardware hasn't really changed.
Well, I think that's in iPhone 17. Again, that will be, what we'll be seeing later this year, into 2025. That's actually going to be a hardware-driven, a new form factor that's really going to be AI-driven. So that's why this is it's a 1-2 punch. It's 16 into 17. And that's why what makes this unique, it's about the increased services. And ultimately, you have hundreds of apps right now in development that are going to be on top of Apple Intelligence. And that's why the enterprise AI revolution's the godfather of AI, Jensen NVIDIA. The consumer AI revolution goes through Cupertino. And I think that's why we could see $4 trillion potentially, today or Monday.
One potential difficult spot, or is a difficult spot, is China. How are you thinking about China, especially with the fact that Apple needs to partner with a local company to introduce all of this?
Sure. Look, Cook, 10% politician, 90% CEO, right? And no one understands.
He might actually have to be more of a diplomat in 2025 than 10%.
And maybe 30%, 70%. But the point is, look, it's what him and Musk have had to navigate in terms of success in China. But what I love about the cycle, that probably gets announced from the Chinese partner early in 2025. It gets rolled out in April. So the China upgrade cycle in terms of AI coming to China, that's something that happens in April. And this is just the beginning of a multi-year AI cycle that plays out from Apple.
You also talk about Palantir and Salesforce in your note. I recently spoke to Mark Benioff about Agentforce and this new iteration they introduced of Agentforce, and he said it's the most exciting thing he's worked on in his entire career. Is that why you're so excited as well about this?
And for context, I mean, Benioff, Mount Rushmore of tech, right? But it speaks to our view. It's 10 p.m. in this AI party that goes to 4 a.m. And behind the velvet ropes, Benioff wanted to see his name's on the list. Now, all of a sudden, he's on the dance floor. Software is let in. Now, already on the dance floor, from a use case perspective, is the Messi of AI, Palantir. And look, that's one, as I say, the bears can't see AI in the spreadsheets. That's how, they hated Palantir as a teenager earlier this year, despised as a senior citizen living in Delray Beach at 83. But it's just the beginning now of what I view as the software age in AI. Salesforce, Palantir, and I think others like MongoDB.
What names do you think we're going to be talking about next year that were very quiet during 2024? 2024 really was about NVIDIA, Tesla. What do you think will be the names of 2024?
Yeah, I think those continue to lead in terms of my view for large cap tech. I think up 25%, 2025. I think what hasn't been on the radar, it's going to be M&A, software, cybersecurity, because with Khan done at the FTC, that nightmare, whether it's Nightmare on Elm Street, Friday the 13th, is done for tech. Now I think you're going to see a lot of accelerated M&A when it comes to software, when it comes to cybersecurity. And I think that is really what's going to lead this AI cycle. And I think specifically cybersecurity is an area that I believe could ultimately be one of the biggest outperformers when it comes to tech.
Another tech analyst joined me this week and said the same thing. 2025 is all going to be about cybersecurity. I want to end on Tesla. Overnight, Elon Musk was clashing with a far-right activist who has been close to President-elect Trump, Laura Loomer. And the crux of the argument was about H-1B visas. But this individual is also saying that Musk really isn't MAGA, and yet he's so close to President-elect Trump. Do you think there's a risk there, actually, that he will lose that proximity to power, which you said was one of the best bets of the ages?
Look, it's a bet for the ages. I think that bromance actually gets stronger between Musk and Trump, because my view is that Trump needs Musk, Musk needs Trump. And whether it's AI, whether it's China, whether it's some of the policies in terms of DOGE, we're going to have these continued dust-ups. So this is going to be a soap opera, I think, for Musk and Trump that continues to play out. But that is going to actually strengthen, and it continues to be for Musk. It's the best bet he ever made on Trump.
Okay, so this is just a flare-up in an episode, not the season finale.
Exactly. View this as just one episode in a 10 to 12-parter on Netflix.
Oh, episodes on Netflix. That's where they end. I mean, just so many analogies throughout that interview. I love the club vibes as well and the silver rope. But just talk about Netflix, actually. It's one of the key drags on the NASDAQ today, Paul. And interesting, after they had a phenomenal performance with the NFL, no technical glitches, and it seems that Beyonce was the real drag with 27 million people tuning in for her particular performance. But it looks like we're worrying more about Netflix's Squid Game. Season 2, the debut, just not living up to expectations, even though 85% critic approval. The New York Times, for example, not liking it. And we saw a fall out of bed for some of those Korean-linked names.
Yeah, I saw that. I can't say I fully understand that whole angle to the story, but, if you think about Netflix, Carolina, it really has become the de facto winner of this evolution of the media industry globally to streaming. The stock is up 85% year to date. It's got a market cap of $385 billion. It has clearly won the streaming wars. And now I think questions for most investors, Carolina, are just kind of, who else can compete against Netflix?
Yeah.
Can Disney? Can Warner Brothers Discovery? Can Paramount? Can some? So that's kind of where we are right now. And I think if you're Netflix, you've got some revenue drivers that I think investors are pretty comfortable about, aside from subscription growth. Advertising and my kids can't scam on my my account anymore. They got to pay for their own, that kind of thing.
Is it it weird for you, though, for someone who has been so steeped in media landscape for so long, that we're back talking about advertising, about live sports, for a name such as Netflix, for a name such as Amazon?
You're exactly right. And as more things change, the more they stay the same. It seems like we're now talking about bundling up some of these apps, these streaming apps. And I kind of said, we kind of did that before. It was called the cable television model. They did it all for us. Did you think you were paying for stuff you didn't want? Yeah, but go take a look at your credit card statements right now. I guarantee you're paying for things that you didn't know and you don't want. It all kind of comes back, I think. But
Paul, I don't want to be anywhere near my credit card statement right now post festivities.
Right. All right, we're going to have more coming up. Jeremy Bryan, Senior Portfolio Manager at Gradient Investments. That's coming up. This is Bloomberg. I'm Paul Sweeney in New York City, Caroline Hyde in London. This is a special edition of Bloomberg Markets. It's special because we're simulcasting on Bloomberg Radio and television. A check on these markets here. A little bit of red on the screen. The S&P 500 is off about 44 points. That's 0.7%. The NASDAQ off about 1.3% here. So we'll keep an eye on the tech-heavy NASDAQ. Light volume, as one would expect on this day between Christmas and New Year. 10-year Treasury yields up just fractionally, 4.59%, let's call it there. On the commodity space, a little bit of a lift to oil. WTI crude oil just above $70 per barrel. So again, a little bit of movement here on a quiet day, Caroline, in the markets. A little bit of rough sailing there.
Yeah, it's been more bright in European trading. We still remain in the green with but an hour and a half or so of trading left, and we're higher across the board, but volumes ever so thin at the moment.
Yeah.
So really we are seeing people just trying to dot their T's, cross their I's and decide how much they're going to take off the table and not take on any more volatility in the last few days of trade.
Yeah. All right, let's see what's going on under the hood here. Natalia Kenievich joins us here in the New York studio. Natalia, what are you looking at this morning in the markets?
Yeah, it's a quiet day, as you mentioned. It's really hard to find stock movers, but nevertheless, we have a few. So Delivery Hero shares are down by almost 5%, and Uber is down by 1.6%. That's after Taiwanese authorities blocked a deal. So Delivery Hero, it's a global delivery company. It's really expanded during the pandemic. It was cutting costs, trying to restructure its business, and recently it sold one of its units in the Middle East called Talabat in Dubai. It was a big IPO of about $2 billion. And now Uber and Delivery Hero, which are two big players in Taiwan, was trying to make a deal. So Uber Delivery Hero was trying to sell its unit called Food Panda to Uber. Uber was planning to pay $950 million in all cash and close the deal in the first half of 2025. But Taiwanese authorities blocked the deal. They see more disadvantages coming from this deal rather than economic benefit. But Uber said in a statement it's disappointed, but it will continue to invest in Taiwan.
Uber off by 1.8%, Paul. Yeah, I mean, we're also seeing the S&P actually falling to the lows of the session at the moment. We're off by about a percentage point. The NASDAQ tech stocks down about 1.6%. Uber, of course, one of them. When you're looking at the industry groups, though, shining more brightly has been the oil sector, but not all energy names are in the green at the moment. And you're looking at a gas company in particular.
That's right. So I'm keeping an eye on natural gas companies. Natural gas in Europe is up by 5%. This is, of course, comes after Russian President Vladimir Putin said that it would be impossible to arrange new transit via Ukraine of natural gas to Europe, of course. And according to Ukrainian authorities, as things stand now, there will be no transit of natural gas via Ukraine starting from January 1st. Overall, as of now, Ukraine accounts for about 5% of natural gas demand in Europe. It's not such a huge share, but nevertheless, it can create some volatility. Europe will be more relying on gas supplies coming from Norway. It's a pipeline gas, as well as LNG exports coming from the United States. And that is why I'm looking at stocks like Cheniere here in the U.S. They are moving slightly. Now it's actually flipped to negative territory, but it was up, and stocks will remain volatile in the next couple weeks, I believe.
All right. Anything else you're looking at here this morning?
Yeah, just a quick update, guys. Arena Group stock is soaring today. The company has received a notice from the New York Stock Exchange American that its plan to regain compliance was accepted. And just a quick reminder, the company got a note from New York Stock Exchange on October 2nd saying that it's not in compliance with minimum stockholders' equity requirements. Now the company will be under monitoring, and it has a deadline until April 2nd. And if it does make any progress, the New York Stock Exchange American may initiate delisting.
Oh, boy. Okay. All right, Natalia, thank you so much. We appreciate that. Natalia Kenievich giving us the latest on some of these market movers here. And as Caroline was just reporting, the S&P off 1% here this morning, and the NASDAQ off about 1.7%. So a little bit of a selling pressure here. A heck of a 2024, folks. A heck of a 2023 in the equity markets. What do you do in 25? Let's check in with Jeremy Bryan, Gradient Investments. He's a senior portfolio manager there. Jeremy, I'd love to read kind of your letter for 2023. 2025 for your investors. What's the theme you're telling them? How are you kind of setting up 2025?
Yeah, I think the biggest theme is what I've been calling pretty simply is bring an umbrella. Right? Bring an umbrella doesn't mean it's going to rain outside, but it means you're prepared in case it does. We've had 2 phenomenal years in the stock market, right? 20% plus both years. And there is historical precedent that we could have another positive year in 2025. So I'm not eschewing that is a possibility at all. But what I'm saying is that you probably have over exceeded what you've, from your growth perspective over the past couple of years, if you've been participating at all. So from that side, taking some of it off to protect assets that you've made over the past couple of years is a prudent strategy. And that's one that we've been advocating for. Bring an umbrella doesn't mean sell everything. It just means be prepared and have some assets that are protecting in case we do not have another 20% year in 2025.
How about that 60-40 portfolio? I mean, I kind of grew up with a 60-40 allocation there, stocks, bonds, and the bonds were supposed to kind of protect me from some of that volatility. It didn't work so well in 2022 when everything was down. But how do you think about fixed income going forward?
Yeah, I think with the rise in rates here recently, I think it's actually relatively opportunistic. From our side, when you have a 4.6% Treasury yield, really that gives you bonds that are giving you 5-6% just from the yield alone. And so if interest rates were to fall for the remainder of the year, that would be, additive on top of that. So from our side, I think 60-40 being dead was, certainly 2022, it felt dead. I think that's overestimated from our side. I think that having a balance and having a component of bonds in there for that income protection is one particular strategy, but it doesn't have to be the only protection strategy you use. There are other asset classes out there, defined outcome, options-based strategies that can also give you a level of protection against the markets that doesn't take the interest rate risk in bonds. So I think having a component of multiple sectors and multiple ways of protecting your assets is probably the preferred method.
Okay, so that protection, that ultimate umbrella, what is causing the rain? What is the catalyst? For you, are you watching the economic data? Are you obsessing about CPI or the inflation gauges that the Fed looks at? Are you more looking at the headlines coming out on Truth Social or on X? Or what is it that you keep a keen eye on in 2025?
Yeah, to us, it's always jobs. Jobs, I know, are a lagging indicator. I get it completely. But from our side here, jobs are always going to drive consumer sentiment, which is going to drive spending, which is going to drive our economy. That's really what we're trying to do and what we're trying to accomplish in economic growth, right? So jobs are kind of, if Americans have a job or feel like they can get a job, they're going to continue to spend money. I know we're hitting limits of, credit card debts at all-time highs and these kinds of things. In my opinion, as long as they still have jobs, we'll still be fine from a spending perspective. And if that's the case, that's what we're going to watch the most, is if that starts to turn over for whatever reason, if we start to see cracks in the job market, I really do believe that that's going to be the catalyst of a potential reduction in just economic growth and activity. And that would be the thing that we're most concerned by coming into 2025.
Okay, so you're talking high-frequency data, jobless claims and the like, or are you still setting your stall on a non-farm payrolls number that just keeps getting revised month in, month out?
Right. Trying to rely on that as the perfect data, it's the best we have in certain regards. But yeah, high frequency data, claims, claims trends is much more what I would say than claims data. Point to point really doesn't matter a whole heck of a lot. But if you start to see upward trending and consistent upward trending in the claims data, that's actual data you can somewhat rely on. And if that number continues to rise upward, that's where I would start to get a little bit more cautious.
Jeremy, how about you and your team? You woke up the day after the election. Did that alter kind of how you think about markets, investing, opportunities, risks? Has that changed?
So after the election, I think the biggest thing that changed was we had a pretty decisive outcome, right, at the end of the day. And what we've always said is that a mixed Congress and a mixed presidential, having a balanced attack, it just really it lowers the volatility of what can actually be accomplished in Washington. And sometimes that allows businesses to actually plan ahead a little bit more because they know there's not going to be dramatic amounts of interference in what's going on because they can't get anything passed. I think that's probably the biggest change that we've seen, is that there are opportunities for an agenda to be more aggressive aggressively mandated going forward, just simply because the numbers are somewhat more in their favor than probably was anticipated prior to the election. So it didn't really change, our fundamental focus and our business fundamental focus didn't really change a whole heck of a lot. What really did change is saying, okay, we have to assume that some of these Republican discussions and agendas with regard to tax situation, which is probably fairly favorable, and then tariff situation, which is the bigger unknown, has greater likelihood of implementation than it did before. And how does that adjust our numbers and who's benefited and who's hurt? That's really we take the analysis. We don't take, I can tell you clearly, we did not make any actions with regard to political action in our portfolios. What we're trying to do is more understand who is benefiting, who is hurting, and making those adjustments within there based upon business fundamentals.
What's really interesting is if you go into some of your single names you've been talking about, Alphabet is one of them. And for me, that still has a regulatory headwind, quite a big one with the new administration, even like the old one. But for you, it's more about a valuation position with Alphabet and indeed perhaps some of the quantum good news helping them of late.
Yeah, completely. And I think that's the consistent theme across the names that I'm talking about is even if stocks have performed well, and, Alphabet's up 40% this year, or 37%. So it's had a really good year. But even with that, the valuation is still well within long-term average ranges. So it's not excessively valued to where there's an aggressive amount of expectations in the stock. And that's where I'd be being most careful right now is stocks that used to trade at 20, 25 times are now trading at 40, 50 times earnings. There's just a higher bar and a higher hurdle and a higher level of expectations in those names. And so what I'm looking for is companies that I think can continue to grow. And I still think Google, despite the regulatory concerns and the risks that are out there, is still going to grow. I think YouTube is a phenomenal business. I don't think search is going away from AI. I think it's pivoting, but I don't think it's going away next year. So from our side, we can take what we think is a reasonable valuation in Google and still get that growth upside to hopefully maybe get a double whammy of price appreciation via growth and price appreciation via valuation extension as well.
All right, very good. Good stuff for us to chew on there, Jeremy. Appreciate it, Jeremy Bryan. He's Gradient Investments Senior Portfolio Manager out there in Minnesota, right outside of Minneapolis, St. Paul, which is a beautiful part of the country. Particularly, I like it in the wintertime. It's pretty cool. Looking at the markets here, S&P 500, we're off 1.2%. The NASDAQ off just about 2% here. So we're seeing an accelerating sell-off in these markets, Caroline. So again, taking a little bit off the table as we near year end. So we're nervous. Yep, we'll keep an eye on that.
Maybe locking in profits after what has been a spectacular year more broadly. We are just perhaps taking away a little bit as we head towards some very thin volumes. They're going to have some outsized moves perhaps as well. And we've got a lot still to be chewing on. Look, we ended the conversation with Jeremy on Alphabet before. He was really talking about those tariffs and how much that's speaking to the lack of clarity for many business operators and investors in those businesses.
Right. And so coming up here, businesses around the world are preparing for the potential Trump tariffs. And we're going to discuss that coming up next, because, again, there's a lot of unknowns out there around the world for a lot of companies, a lot of different countries around the world of what the economic policies of the United States will, in fact, be going forward. So we're going to have some more on that coming up in just moments. This is Bloomberg. Good morning. All right, I'm Paul Sweeney in New York City. Caroline Hyde, she's in London. This is a special edition of Bloomberg Markets. We're simulcasting live on Bloomberg Radio and television. A quick look at this market check here. S&P 500, we're off 1.25% here. That's 75 points on the S&P 500. The Nasdaq's off over 400 points. That's 2%. The Nasdaq, I'll call out the Dow for Jonathan Ferro, off 300 points at 0.7%. 10-year Treasury yield, pretty steady here, about 4.58% on the 10-year Treasury. In the commodities front, a little bit of a lift to WTI crude oil, up just fractionally, just above $70 per barrel. The Chinese government is pledging more stimulus as it looks to stabilize economic growth in 2025. Bloomberg's David Gurr sat down with Treasury Secretary Janet Yellen earlier this month and asked her about the U.S.'s relationship with China. Let's take a listen.
Many countries, when they're faced with unilateral actions of that sort, look for ways to retaliate. And my guess would be that they would do that. We have in areas of concern where I've expressed repeatedly concerns with overcapacity that is developed in Chinese advanced manufacturing industries and clean energy, semiconductors, and the like. We think it reflects active, large subsidies that are flooding the world with exports and threaten to drive our firms out of business in areas that we think are critical to our own future. We've put in place tariffs. Now, they're strategic. They affected $18 billion worth of trade, certainly not all of our trade with China. And we did it to make sure that China's actions don't undermine our own plans to support these sectors. But broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness of firms that rely on those imports. So we've taken a strategic approach, focusing narrowly, and a broad-based approach I have serious concerns with, as most economists do.
Treasury Secretary Yellen really digging into the relationship between the US and China, the strategic tariffs thus far that the administration under Biden had put in place, largely affecting the chip sector and deep technology. But we know that the hint is those tariffs are likely to broaden coming into 2025 under the next administration. What does that mean for businesses? How are they already preparing? That is the subject matter of today's Big Take. It is a must-read. And coming up early for us from LA is John Gittleson, who is one of the authors behind today's Big Take. How Trump tariff threats are already roiling global trade. You go into this deep dive of individual companies, how they're already having to have a surge of shipments from Germany, whether it's Riesling wine or whether it's the latest maker of wires and technology from the US in California. How are they trying to front run some of the tariffs that we're expecting, John?
Well, exactly. There's been a record number of containers running through the ports of LA and Long Beach, the biggest North American ports, just in the last couple of months, because people are trying to get ahead of this. But at the same time, they're balancing, like, we don't want to overorder. In the case of, there's a company that has ear pods that they supply, not Apple ones, but their concern is technology changes very fast. If we order too much ahead of time, we'll be stuck with all this inventory that people won't want to buy. So they're trying to balance all these things, get it in while prices are cheap, beat the tariffs. At the same time, don't overorder. There are also higher costs if you rush to get stuff in because freight costs have gone up a lot.
So, John, it's interesting. We don't even know what's going to be subject to tariffs, how much, any of that. But it appears that companies just aren't waiting, are they? They're trying to just get ahead of this any way they can. I mean, it's just extraordinary.
Well, yeah, they're trying to figure out what to do, because the other concern is people thought, well, let's have stuff imported via Mexico, assembled in Mexico, and that way we could get around the sort of Chinese content rules on tariffs. But now, recently, Trump said, well, we want to impose tariffs on Mexico and Canada because we're concerned that they're letting, bad guys and fentanyl into the U.S.
Look, we're looking at a market that is currently under some significant selling pressure today. We're off by more than 2% on the Nasdaq 100. Is there a flavour of which industries are bracing themselves the most? Like, I've been reporting all year on the chip sector and how they've had to be navigating the China-US relationship. But you've already mentioned wine, technology. This is so broad in its remit. Autos. Where are we seeing the most anxiety build?
Well, I would say across the board. I mean, clothing is another one you mentioned, or didn't mention, but yeah, electronics, clothing, just about anything that's made overseas, which is most of the consumer goods that we have in the U.S. Lawn furniture. I mean, it's not something that I go, oh my God, I won't be able to live without lawn furniture. But at the same time, there are a lot of knock-on effects, as Secretary Yellen was talking about. It'll cost more ultimately to consumers, and we're not sure whether that's good for the economy or bad.
You've got a great graphics here, like the Big Take stories, folks. They're deeply sourced, deeply reported, and they've got great graphics, which makes it just come alive. Tariff talk abounds. Companies, you guys tracked how much companies talk about tariffs on their conference calls, and holy cow, it spiked in November and December this year. So this is on the top of minds of corporate executives, isn't it?
That's right, exactly. I mean, we have ways of searching texts of calls all over the place, and we use that as a tool. It's like, yes, CEOs say that's a big issue for them going into 2025. And it's uncertain, too. I mean, that's part of the deal is we don't know what's actually going to happen because Trump has talked a lot, but he's not president yet.
And that must be the frustration that ultimately a lot of these business leaders know that they're having to drive up costs, perhaps unnecessarily, but they've just got to make a call. They've got to decide whether they're going to front run something that's hypothetical in nature. Do we know how much is driving up costs?
Well, we don't know yet. I mean, and we don't know how much they're going to pass on. There are higher costs for shipping right now, and a lot of people are using air freight instead of using ships because they want to get it here earlier. There's stuff that if you order it early, you have to put it in a warehouse before you put it in stores. So that could be an extra cost too. And then we don't know what other kind of tariffs will be added on. So it's very hard to know how much each unit is going to cost, how much the people who are processing or passing on those units are going to pass on to consumers too, because you don't want to raise your prices too fast. And then there are, in the case of like the German winemaker, maybe they're just going to export to Scandinavia instead of the US because they think I can make money in Scandinavia. They're not a major exporter of wine. Some of their competitors, though, they can't do it without the US.
I mean, this is no joke here. I mean, you have some research from Oxford Economics where I think they polled executives. What are the biggest worries you have over the next 2 years? And we're talking Eurozone crisis, China, Taiwan. I mean, big issues. The Middle East, by far, the biggest one is the global trade war. So this is on top of mind of just about everybody out there.
That's right, yeah. And as Secretary Yellen said in the previous segment, we don't know what kind of retaliation is going to happen. They're talking about using a very blunt instrument across the board, tariffs. And so people will retaliate and people will stop paying. We all know consumers are very unhappy about inflation now. We don't know what effect higher tariffs are going to have on inflation, but generally it raises the cost of imported goods if you put tariffs on them.
All right. John, great reporting. John Gittleson, Bloomberg LA Bureau Chief, one of the contributors to the Big Take story. Check out the Big Take stories on the terminal. They are fantastic reporting every single day. You can go to Bloomberg.com/Big Take. Find them online as well. Markets selling off here. S&P 500 off about 1.27%. That's 77 points. And NASDAQ off over 400 points. That's about 2 percentage points there. So a sell-off on light volume, which tends to happen. You can get volatility on these days of light volume. That's certainly what we're seeing here. Coming up, we're going to discuss the outlook for energy markets with Ellen Wald, Senior Fellow at the Atlantic Council. That's coming up in just moments. This is Bloomberg. All right, good morning. I'm Paul Sweeney in New York City, Caroline Hyde in London. This is a special edition of Bloomberg Markets. We are simulcasting on Bloomberg Radio and television. Looking at this market here, we do have a sell-off here developing just over the last half hour or so. S&P 500 off about 80 points. That's 1.3%. The NASDAQ is off about 2%. And I'll note the NASDAQ volume here is higher than the average. So we're seeing some volume in NASDAQ here. So we'll keep an eye on that. 10-year Treasury yields off slightly. We're now around 4.57% on your 10-year U.S. government bond. In the commodity space, WTI crude oil a little bit higher here, just above $70 per barrel for WTI crude. For years, energy investors have preferred oil stocks versus natural gas peers. But now, looking toward the year ahead, traders are betting on gains, and gas will fuel their portfolios more than crude. For more on energy, joining us now is Bloomberg's Natalia Kenyon-Jevich. Natalia, thanks so much for joining us here yet again. What drives this divergence between oil and gas, and kind of what's happening in 25?
Right. So typically, natural gas stocks follow oil shares. But this year, as you mentioned, we see some divergence, and this is driven by fundamental factors. Also, just as an example, when we look at a company like, let's say, EQT, it outperforms oil giant ExxonMobil. It's quite a big move. So when it comes to natural gas prices, we see that they are moving higher. First of all, it's a global demand, more demand for American gas coming from Europe, and LNG exports are rising, of course. And there is a second part of this story. It's more related to the so-called AI play.
Okay.
So this year we saw utilities were a big play for AI because of demand coming from data centers. And now
I did not see that coming. I'll tell you that. Smart money did, though.
Yes, and now some people I spoke with are saying that natural gas prices can be the next kind of part of this play because there is more demand for gas-fired power coming from data centers, and as a result, they can benefit. And then on the flip side, of course, oil is not doing as well.
And a lot of these data center buyers and builders are ultimately big tech companies that have a lot of commitments from a clean energy perspective as well. So they're really trying to forage out where they can add to their clean energy proviso. That's why nuclear has become such the watchword when it comes to the AI trade. But push us forward to 2025. Does that change in where we're looking, whether it's gas prices outperforming those that are movements within oil? Does that continue? Where does the demand supply end up looking?
Right. So we see that, first of all, seasonality on top of these geopolitical factors. Here in the U.S., we see that every year in November, demand for natural gas is moving higher. That is also what we see this year. And then on the flip side, oil is down by 6% year to date. Of course, the biggest driver for that decline is China, weak demand in China. So, for example, the latest data points coming from China's economy shows that industrial firms saw profits drop in November for a fourth straight month, and this is a really sharp decline. And we see some pessimism around forecasts for global oil demand again. So, for example, OPEC cut demand growth for the fourth straight month, and now it slashed projections by 27% since July. So people are becoming more pessimistic when it comes to demand for oil. And then even if we compare forecasts from OPEC to, let's say, investment banks like Morgan Stanley, Goldman Sachs, it's still very optimistic, and it's much more optimistic compared to International Energy Agency, because IEA says that oil market will see a surplus of more than 1 million barrels next year. Again, this is all related to China, and everyone expects China to recover, and maybe those stimulus that the country announced will help with Chinese economy to grow faster.
Maybe while oil is a little bit higher on the day, unlike the rest of the broader markets. Natalia, so great to check in with you. We thank you very much indeed on all things oil versus gas. Let's just dig into the geopolitical persuasion a little bit more, and indeed what the outlook for some of these energy markets is going into 2025. Perfect person to do that. Ellen Wald is with us, Senior Fellow at the Atlantic Council and author of Saudi Inc., the Arabian Kingdom's Pursuit of Profit and Power. I am so interested in your take of what the next administration means for the relationship with Saudi, with Israel, and going forward. But just taking on where Natalia was bringing us, the supply-demand dynamics around oil, and just how important is OPEC at this moment?
So I think OPEC is actually playing a fairly critical role right now because they're keeping a fair amount of oil off the market, and they're really enabling the U.S. to have a role, for its oil space, for its oil market to grow. If, for example, OPEC were to decide, hey, all bets are off, we're going to just open the taps, forget about all these cuts, we're just going to put all of our production capacity back on the market, they have the ability to tank prices. I think they don't want to do that right now, and but a lot in terms of the oil market hinges on whether OPEC is going to move forward with its very gradual plans to put more of that oil back on the market, or whether they're going to continue to push it off. So I think that they're still very, very relevant, just not in quite the same way as they were, say, in the 1970s.
All right, Ellen, I have to fully disclose here, I am a big fan of the TV show Landman, so I now consider myself an expert on oil and gas and all that kind of stuff. But talk to us about the U.S. supply, because that's really changed that dynamic in global oil and gas over the last 10 years or so. Are those guys going to be drilling going forward?
Yeah, that is a great question, and you're definitely pushing me to start watching this show in my free time. So thank you for that. So I think that this is not the same oil market as in 2016 and 2018. This is a different shale patch. Back then, it really was a drill baby drill situation because we had lots of companies out there. It was kind of like the Wild West in a little bit of a sense, and they just had to keep on drilling and drilling, even if they weren't, breaking even just because they needed to make payroll. They needed to get all that oil out there. They were being funded with the intent to just drill. That time is over. We're in a different oil market now, different shale patch where we've got a lot of consolidation. We've got much bigger companies at the helm now, and they're a lot better capitalized. They're much more focused on not necessarily just growth, but on returning value to shareholders. Coincidentally, we happen to be producing at the highest levels ever right now, but companies are also using a lot better techniques, a lot more sophisticated techniques to find oil, to get more oil out of each well. And so I think, yes, we still do have a lot of oil to get out of there. We're still going to be producing at fairly high levels, but that same mentality and the ability to kind of predict where we're going is not there now. It's really a different look. Now, when it comes to the Trump administration and drill, baby, drill, I think that we're going to see that much more in the offshore oil space, because that's really an area that has suffered greatly under the Biden administration's regulatory restrictions. And so I think we're going to see a lot more optimism there, because that's an area where things take a lot more capital to get going. You need a lot more time. You've got to invest a lot more. But at the same time, those wells can last a lot longer than what we're seeing in, say, the Permian and those areas. So I think they're really looking forward to a Trump administration to help them get the leases they need, get the permits they need to start drilling. And I do think that is an area where we are going to see a more kind of drill, baby, drill outlook.
Ellen, the outlook under the next administration of relationships with Saudi Arabia, of relationships with Israel and normalization with the Arab world more broadly, how are you looking at that and what it means for your markets that you eye?
Well, I think that this is a really complicated area because I do think that the Trump administration is much more unabashed in its support for Israel, particularly in a military sense and in a diplomatic sense. So I think you're going to see a lot more very overt and very strong support for Israel. Does that necessarily mean that's going to put them at odds with the rest of the Arab world? I don't necessarily think so. I do think that they definitely have a much more stronger stance on Iran. It is entirely possible that we could see them start to enforce the oil sanctions on Iran more forcefully. And if that takes Iranian oil off the market, that will actually be good for Saudi Arabia. That's actually what Saudi Arabia, the UAE would like, because they can put more of their oil on the market, or it will help prices go up. So I think that while there's definitely a tension in terms of the relationship between Trump and the Saudis, I think that the underlying aspects in terms of stability, in terms of trying to lessen Iran's funding of terrorist groups, I think that are all going to bring that's what the Saudis would like to see, and that's what the Trump administration wants to see. So while they may not necessarily show that they're best buddies in terms of U.S. support for Israel, I do think that there are a lot of aspects where they're going to see a lot of synergy.
Ellen, if I'm a proponent of green energy, how concerned should I be about the incoming Trump administration about that process?
So I think it really depends what your approach to green energy is. I don't think the Trump administration is looking to say roll back the entire IRA. I mean, this is an administration that really also has a vested interest, really wants to increase the domestic lithium and lithium battery supply chain in the United States. They may have a slightly different reason for wanting this. They consider it more of a national security concern than, say, an imperative to put more EVs on the road. But this is an area where where, they definitely will have a lot of support there. And I think that there are a lot of areas where they can work together. Now, if you're looking at, say, offshore wind, I don't think you're going to see a whole lot of support from the Trump administration. But to be totally honest, the offshore wind industry in the United States has got a lot of headwinds, even, without President Trump kind of putting the brakes on that. They've got issues in terms of the turbines that they're using, collapses in the Atlantic, problems with funding for projects, off of New York and New Jersey. The Trump administration is a convenient way to excuse, perhaps, a lack of interest and difficulty getting it going. But I wouldn't say it's necessarily the Trump administration's fault that offshore wind is having a really difficult and slow start here.
Ellen, what about nuclear?
Yes.
That is an excellent question. And I think that is something that the Trump administration could really make a mark on in energy if they choose to address this. Because I know you said on the previous segment about data centers and these big tech companies, they want to use nuclear to power their data centers. They realize that, look, we've got to get something that's more reliable. We can't use wind and solar for this. So it's either natural gas or nuclear or a combination. And that is an area that the Trump administration could really push things forward. We've got a lot of really interesting technology in terms of small modular reactors coming up. And this is an area where they could really push things forward and help bring more safer, better, more affordable nuclear technology to the United States. We really haven't had a new nuclear plant. It is incredibly difficult to build a new nuclear plant. But nuclear is a stable, great baseload source of energy that is actually incredibly safe. And so there's a lot of things that they could do to help push that along, bring that to fruition in safe ways that would really also help the environment and lower emissions.
All right, Ellen, thank you so much. We appreciate that. Ellen Wald, Atlantic Council Senior Fellow and author of the book Saudi Inc. So one of our go-to voices on energy. And Caroline, I was on holiday through Ireland this past September, and there are windmills everywhere. Mm-hmm. I don't know. I don't know how I think about that. I mean, beautiful Irish countryside, then you got these big windmills. Now, if they're producing a ton of energy, I guess maybe it's worth it. I don't know.
Same in the north of England, same as offshore in the UK.
Yep.
And Europe, of course, has been far more promotable of clean energy and sources and use cases, and have financed clean tech far more than the United States perhaps has. And that shift changing, but we'll see how resilient they ultimately end up being and how resilient the overall electricity grid remains in the UK and across Europe. But yeah, for some it's an eyesore, for some it's particularly beautiful. But just that ongoing dynamic. I do wonder how much we'll see a shift into nuclear coming up.
Yeah, and some of the folks who are a little bit more cautious about green energy said, the amount of fossil fuels that were burned to construct these windmills will never be paid back in their 20-year life. So there's two sides to that story, I guess. So we'll keep an eye on that. S&P 500, we're off 1.2%. The NASDAQ off 1.9%. We're going to have more coming up. This is Bloomberg.
We welcome you back to a simulcast radio and TV audiences. We go worldwide. I'm sat here in London, Caroline Hyde, and Paul Sweeney over there in New York. And we are looking at a risk-off day, Paul, really starting to see at the bottom the NASDAQ 100 coming off of its lows of sub 2%. But as you noted, volume's actually higher, 30% higher than the last average of the 20 previous trading days. So clearly people trying to tie up their books as we end the year out, and money coming off the table. Nvidia, a key name that's lower.
Yeah, absolutely. So again, I think we're seeing some names kind of move around here. Generally, when you look at the S&P and the Dow, the volume's a little bit lighter, but a little bit higher there in NASDAQ as we see some big moves there. 2024 turned out to be a pretty good year for global Wall Street. We're talking about bonuses being higher and all that kind of good stuff. But of course, when you listen to some of the Wall Street folks talk, they're saying 2025 with this new Trump administration might be even better. JP Morgan CEO Jamie Dimon, he sees companies pursuing more M&A in the upcoming Trump administration. He spoke with Bloomberg's Lisa Abramowitz. Let's take a listen.
Because they have the Senate, the House, and the presidency, they have far more ability to do things like that. I think last time around, President Trump had started by saying for every new regulation, 1 in, 2 out. And I think later he said 1 in, 5 out. I think they could do some of that again. I think it will, the banking industry, whether you voted for Trump or Joe Biden, a lot of bankers, they're like dancing in the street because, they've had successive years and years of regulations, a lot of which stymied credit. And so and you could have kept the banks equally safe, but had them do more credit. And so, like, to just give an example, the average bank in America, I think the number used to have $100 of deposits and $100 of loans, and now it's $100 of deposits and $65 of loans. And if that's what you want, if for some reason the regulators think they're geniuses and that's the best way to run the banking system, so be it. But I think they did a lot of things that ended in that answer, but they didn't know that was going to be the outcome. So, and I think you could talk to any industry, and they'll give you examples of regulations that could be reduced and make it easier for them to do business while keeping the country safe, while keeping the air clean, while making sure the EPA does its job, et cetera. So I applaud them. They should be looking at those things.
Do you think if there is, particularly in the banking sector, less regulation, that there will be an even steeper competition with banks getting back some of the business from private investment firms?
Probably, yeah. I mean, because if you look at, you're asking about private credit and private investment, which I'm not against, and it has grown very rapidly, and it's got pros and cons. I'm always in favor of competition, but part of the reason that they are dancing in the street, which they said publicly, they used to get mad at me, now they say, no, he's right, is half the capital. No social requirements, no AML, no BSA, no fiduciary, no reporting to the government, no insurance, no liquidity. It's a huge disadvantage. So, I think it'll make banks get back some of that business. I think it'll be more important to regional banks than to JP Morgan.
There's also a question whether it's banking mergers and acquisitions or just more broadly, whether there's going to be a more amenable administration to tie-ups. Are you seeing from your conversations in the past 7 days with companies that they are looking to expand their M&A pipeline to start putting that together?
Yeah, so absolutely. I mean, a lot of M&A was stymied by the fact it's not just sometimes you can't get through the courts or something like that, but it takes 2 years. It takes 3 years. So make believe you're a bank, and we've seen this happen. And one of these deals actually took 3 years. It takes 3 years to get it done. So you've done a deal. It's binding. You haven't closed it, but now you've got to run the company. You can't get the synergies. You're going to be losing people. You want to start working a common culture and common technology. You can't do it. So a lot of companies are looking at will be looking much more aggressive at acquisitions and deployment of capital, and they should.
CEO JP Morgan, Jamie Dimon, speaking with our own Lisa Abramowitz in Peru a little earlier in the year. But let's just talk more about the M&A outlook, whether we're going to see it take off in 2025. Mike Hythe is with us of Bloomberg News, sat over on the West Coast. And Mike, just put the context. How did 2024 end up looking for M&A? Which industries in particular? Where are the biggest deals?
It was pretty good, actually. There was a lot going on. It was a lot